When you look at the U.S. economy today, there are parts of it that are doing really well. For example, if you look at unemployment, unemployment is the lowest it's been in, well, decades. If you look at productivity, we've seen some recent increases in productivity. Both of these bode well for the U.S. economy over a long-term period. Unfortunately, we're seeing evidence that there is some moderation or slowing, if you will, beneath the surface. For example, if you look at manufacturing employment has come down pretty sharply in the last couple of months. We've seen that with layoffs from major auto industry in this country. Another example is if you look at cardboard production. Cardboard production has seen the largest drop-off since around 2009. If you think about it, cardboard's a huge leading indicator. Most of the things we get, or many things we get on a daily basis, whether it's meals at night, whether it's what you need around the house, comes in a little box to your front door. That drives cardboard demand. When you see cardboard demand slow, that means less people having less things shipped to their front door. So these types of anecdotal indicators are indicating that we will see moderating, slower growth in the future. One other issue that is causing us some concern for the U.S. economy is of late we've seen the U.S. Treasury yield curve for the second time this year invert or flatten out to about 12 years out. Essentially what that means is that the U.S. government, when they go to borrow money, is actually paying more to borrow money for 3 months than they are to borrow money for, say, 10 years. That sounds a little wonky, but what that really tells you is that the expectation for future growth is lower than current growth. Often, a flat or inverted yield curve can lead to a recession, but not always. But what it always leads to is a slowing or moderating economy. So we see a slowdown in manufacturing, we see the demand for cardboard drop off, and we've seen the yield curve flatten or invert. These are all signs that economic growth going forward is not going to be what we saw, let's say, for the past year. Well, if you look at the trade negotiation between China and the U.S., there was at least in the U.S., there was a pretty strong belief that whatever came out of the trade discussions was going to be relatively benign. There wasn't going to be a lot of strong impact one side or the other. The last couple of weeks have shown that that may not be true. Both the U.S. and China are economically in a pretty good place. While the U.S. may be seeing some moderation in the future, the economy remains pretty resilient and pretty strong. The Chinese economy has strengthened substantially over the last year to 18 months, as China has done a pretty significant stimulus program throughout their country. So both countries are coming, if you will, from a pretty good economic foundation. And both countries, believe it or not, have a pretty strong political foundation where there's a consensus in China of what they're trying to do. And even though there's discourse in Washington, there seems to be a pretty strong consensus in the U.S. of what they want to achieve. So from a U.S. perspective, I think the trade escalation, if you will, of the trade war is a really big deal because it flows into many of the industries that are, quite frankly, key and have been the drivers for both the U.S. economic growth and for the growth in the U.S. stock market. So our backdrop right now is that we're seeing a moderation in the U.S. economy. We're seeing trade tensions between China and the U.S. escalate. And the tensions have really gotten around about the core of the issue at this point. It's really about transfer of technology from U.S. to China and the protection of U.S. intellectual property. And those are going to be really sticky issues, and those are going to be with us, I think, for a very, very long time. In the near term, I think what we're going to see is some increased volatility. We're going to see perhaps the markets pull back a bit from here. Would not be surprising. And the other thing is that if you think about the U.S. economy and, if you will, the U.S. leaders in the U.S. stock market, it has really been technology-led. It has been the semiconductor companies. It's been the internet companies. So when we look forward, a lot of these things that have led the U.S. economy and led the U.S. stock market are probably going to be under pressure. The good news is this creates a tremendous opportunity. We right now are sitting with a large short-term treasury position, a gold hedge in our portfolios, and high cash. So when we look at the markets today, what we're looking at is what do we want to buy and at what prices do we want to buy it. Many of these issues are going to be with us for a long time. The companies in the United States are extremely resilient, and once they understand the rules, they'll be able to adapt, modify, and move forward. So when we look at right now, we see the escalation in trade tension, moderating U.S. economy as a tremendous opportunity for our clients, and we're looking forward to the next 2 to 2.5 years of what should be, once we get through this phase, pretty good growth.